Okay, imagine this. You wake up tomorrow, the year is 2026, and your entire financial life is a completely clean slate. No investments, no savings, but you have all the knowledge you have right now. That would be a huge advantage, right? Well, today we're going to borrow that advantage. I'm going to lay out the exact step-by-step plan I would use to build wealth from the ground up, but faster and with way less stress than trying to figure it all out on your own.
So here's our roadmap. We're going to start with why just saving your money isn't going to cut it. Then I'll show you a really smart shortcut. We'll cover 2 non-negotiable rules you have to follow before you start. I'll walk you through making your very first investment, and then we'll wrap up with the mindset that really makes all the difference in the long run.
All right, first things first. We absolutely have to talk about why that money you have sitting in a bank account, well, it isn't as safe as you might think. In fact, doing nothing is actually costing you.
Let's say you've worked hard, you've been disciplined, and you've managed to put aside $1,200. That is awesome. But now you're at a crossroads. Do you save it or do you invest it? And let me tell you, the answer to that question is going to have a huge impact on your financial future.
See, there's this invisible force out there called inflation. It's just the slow, quiet way that everything gets more expensive over time. It means that the $1,200 you have today will buy you less stuff next year, and even less the year after that. It's like you're losing money without even spending it. You're losing purchasing power just by standing still.
So this is where the difference between saving and investing really comes into focus. When you save, you're basically just parking your money. The bank might pay you a tiny bit of interest, sure. But when you invest, you're not just parking your money, you're putting it to work. You are becoming a part owner of actual businesses that are trying to grow.
And this chart just lays it all out crystal clear. Look, a high-yield savings account is great. It can help you keep up with inflation. But if you truly want to build wealth, the stock market, on average, has historically provided returns that are in a whole different league. Saving protects your money, investing grows it.
Okay, so we've established that investing is the way to go. But this is the part where a lot of people get intimidated. I mean, how are you supposed to pick the winners and avoid the losers? Well, guess what? There's a shortcut.
I mean, we all dream of this, right? Finding that one company that just takes off. If you had the foresight to buy a single share of Apple back in 2010 for about $10, well, that one share would be worth over $200 today. That's a 20x return. It shows the incredible potential of backing the right horse.
But, and this is a huge but, for every amazing success story like Apple, there's a cautionary tale like Palm. They were a super hyped smartphone company that just disappeared. If you'd put all your money into that one stock, you'd have lost everything. That's the intense risk you take when you try to pick individual companies.
So what if I told you you don't have to play that high-stakes game at all? There's a much simpler and, frankly, much safer way to do this. It's called an exchange-traded fund, or an ETF. The easiest way to think about it is like a basket that holds tiny little pieces of hundreds of different companies, all bundled together into one thing you can buy.
The best shortcut for a beginner is to buy an ETF that just tracks a big market index, like the S&P 500. An index is really just a list, and the S&P 500 is the list of the 500 largest, most stable companies in the US. So with one single purchase, you instantly own a tiny slice of Apple and Microsoft and Amazon and hundreds more. This immediately lowers your risk because your success no longer depends on any one single company.
Okay, before you get excited and jump in to put a single dollar into the market, we need to build a strong foundation. There are 2 rules, and they are absolutely non-negotiable that you have to follow to set yourself up for real success. First, you have got to get rid of any high-interest debt you have. I'm talking about credit cards, mainly. Trying to invest while you're carrying a credit card balance with a 23% interest rate, it's like trying to fill a bucket that has a giant hole in the bottom. You have to plug that hole first.
This quote just nails it, doesn't it? That debt is constantly working against you, draining your money away. It's almost impossible for your investments to grow faster than that debt is shrinking your wallet. It will always drag you down until it's gone.
All right, rule number 2, and it's just as important, is creating your financial safety net. You know, life happens. It's totally unpredictable, and you need a cushion for those just-in-case moments so they don't completely derail your long-term goals.
So what you're shooting for here is to have 3 to 6 months of your essential living expenses stashed away in an account you can get to easily. This is your car broke down fund, your unexpected medical bill fund. This fund is what ensures you never, ever have to panic and sell your investments at the absolute worst possible time just to cover an emergency.
Okay, your high-interest debt is gone. Your emergency fund is in place. You are ready to go. And here's the best part. The actual process of making your very first investment is so much faster and simpler than you probably think.
Seriously, the whole thing just boils down to these 4 simple steps. First, you open an account at a brokerage. Think of it like the store where you buy investments. Second, you choose the right account type for your goals. Third, you move money into it. And finally, you click the button to buy your first ETF. That's really it.
Now, a really key decision here is the type of account. For most people starting out, a Roth IRA is just an incredible tool. You put money in, it grows completely tax-free, and then when you take it out in retirement, it's all yours, no taxes. A regular taxable account is more flexible, but you will have to pay taxes on your profits as you go.
And one last little detail to watch for when you're picking that first ETF is something called the expense ratio. It's a tiny annual fee, but those little fees add up over time. You want this number to be as low as possible. Keeping your costs down is one of the easiest ways to make sure more of your money stays in your pocket, growing for you.
So you've bought your first ETF. That is a huge milestone, and you should celebrate it. But it's really just the starting line. Real lasting wealth isn't built by what you do on day one. It's built by the mindset you carry with you for all the days that follow. The first key is this classic idea. Pay yourself first. Treat your future self like it's your most important bill. And the absolute best way to do this is to automate it. Set up a recurring transfer from your bank account to your investment account every single payday. That way, you're building wealth consistently without ever having to rely on willpower.
Second, and I really cannot stress this enough, you have to stay the course. The stock market will go down. It's not an if, it's a when, and it can be terrifying to see your account balance drop. But you have to resist the urge to panic and sell. History has shown time and time again that markets always recover. The biggest gains often come right after the biggest drops, and you have to be in the game to catch them.
And this brings us to the final, and honestly, the most important rule of all. The best tool you have as an investor isn't some crystal ball to predict the future. It's consistency. No one can tell you what the market is going to do tomorrow. The only thing you can control is your own actions, to keep investing, month after month, year after year, no matter what the news says. That is the real secret.
So there you have it, the whole roadmap. Building wealth isn't about some secret trick or chasing the latest hot stock. It's about understanding the basics, building that solid foundation, and then just consistently taking small, simple actions over a long period of time. You have the map now. The only question left is, where are you going to let it take you?